This final proposed change is the most difficult and I think will cause us the most grief, discretionary trust. Very, very difficult thing to understand, lots of potential issues with it. So here I've highlighted quite a lot of the potential problems. I think we really will have to work through with everybody how we're going to tackle this sort of on a case-by-case basis because everyone is different. But the announcement is from 1 July 2028, so it's still not for 3 tax years. We've still got 26, 27 and 28 to go, all is normal, but then after that, 30% minimum tax on distributions from a discretionary trust. Tax is supposed to be paid by the trustee of the trust. So the trust lodges its tax return and gets an assessment that it has to pay tax on, which is not how it's working now. The tax that it pays then becomes a non-refundable tax offset for beneficiaries to use against their tax on that income if the income was distributed to an individual or a trust, but not if it's distributed to a company. The company does not get any of that offset benefit. And if a trust has received franking credits, it will use the franking credits to pay that 30% tax liability first. It says consultation will occur to make this workable. And there is supposed to be some rollover to allow people to restructure from trust to companies. It says for businesses that operate through trusts and others. And this rollover, there's no detail about it at all. It says consultation will apply about that, and it will apply for 3 years from 1 July 27. And it says the introduction of a 30% minimum rate will mean a fairer rate of tax paid on discretionary trust income, better aligning the tax rate on trust income with the tax rates paid by workers. It doesn't apply to fixed trusts, widely held trusts, special disability trusts, deceased estates, charitable trust, or existing testamentary trusts from people that have died before the 12th of May 2026. Or to primary production income, or some other very specific amounts. But in general, it will apply to nearly everything, because we have very few fixed trusts. So here's an example, which is a very simple one, with a trust that just has some cash invested in a term deposit and it's earning interest. So we've got this discretionary trust earning $30,000 of interest, and we've got 2 individuals, Bob and Courtney, getting half of that income each, being $15,000, and they've got no other income. So now they would be below the tax-free threshold and pay 0 income tax on their $15,000 income. But from the 2029 year, the trust would have $30,000 of income and be assessed to pay $9,000 tax, being 30% of that. Bob and Carol then get their $15,000 and get credit for $4,500 tax paid each, but it's not refundable, so that $9,000 just disappears. This has a really easy fix in terms of tax outcome. You just put the money in Bob and Courtney's name. They get taxed on $15,000 in their own names, right? They pay no tax. But you have an asset protection issue in that they own it, you know, that cash personally, and you have an estate planning issue in that, you know, if they have anyone looking to challenge their estate, it'll be part of their estate, whereas it wouldn't have been if it was in the trust in the first place. Next example is a franked dividend. So here we have a $35,000 franked dividend with a $15,000 franking credit. Bob and Courtney, again, no other income. So now we'd have $50,000 of trust income. Bob and Courtney get taxed on $25,000 each. There's a little bit of tax paid on that, but they get most of the franking credits refunded, $6,400 each. In 2029, this $50,000 will be the taxable income of the trust, and it'll get taxed at 15% on that, being $15,000. We have that much franking credit, so it doesn't have to pay any more, but the franking credit changes its character from being a franking credit to being a non-refundable trustee tax paid. So when that is distributed to Bob and Courtney of their $25,000, they have $7,500 of non-refundable credit, which definitely covers the tax on $25,000, but they don't get anything back. It's not franking credits anymore, it's trustee tax paid. Now there is a sort of fix to this again. Okay, well, can we just put these shares in their name? It has again the same asset protection issue, the same estate planning issue, but additionally you have a CGT on transfer issue. I wanted to talk about what happens if you have, can you ever get any franking credits refunded? I think you probably can. It doesn't explain this, but this is just how I think it's going to work. Same situation, but we had some gearing here. We had $10,000 of interest expense as well. So we've only got $40,000 of income now. So at that point now, we're pretty much getting nearly all the franking credits refunded, because we've got even less income than before. But in 2029, we'd have only $40,000 of taxable income. So at 30%, $12,000 of the franking credits converts to this non-refundable trustee tax paid. But we still have $3,000 of franking credits because there were 15 to start with. So I think then that we get our $3,000 refunded, $1,500 each, because they're still franking credits. Next problem. We have a discretionary trust and we operate our business through it. This is the example in the ATO's fact sheet, which is another very long fact sheet from budget.gov.au about how this minimum tax will work. So here we have $200,000 of business income from our hard work, and we distribute $100,000 to each of us from working there. So now we would each get taxed $20,800 on that income of $100,000 each. In the future, if we had this through a trust, the trust would get taxed at 30% on that, being $60,000, and then when we distribute our $100,000 each, none of it's refundable, so we've paid 30 each instead of 20 each. So we're $18,000 worse off by trading through this trust. The government's solution to this says that people can instead just pay themselves wages, and the trust will have no income and they'll get taxed on the wages. They say that the tax outcome will be exactly the same. Of course it won't be, because if you pay yourself wages, you also have to pay super, meaning that you'll end up with $15,000 less cash in your pocket after you've paid the super. So in both these circumstances, poor Bob and Courtney have lost, $15,000, $18,000, and how are they going to pay their mortgage then from their small business? There's not a super easy fix to this. They could trade in their own names. That would be a huge asset protection problem to run your business in your own names. Again, it'll be an estate planning issue, and it could be a CGT issue to move a business. Well, it definitely will be a CGT issue to move a business. We don't know what that rollover will look like. But this government can change also, the income tax rules, but they can't change any duty rules. So, you will also be relying on all state governments to pass stamp duty relief as well if you're trying to restructure things. Here we have a discretionary trust with a large income. So we have a business running that's making $1 million of income, and Bob and Courtney are running this as well, and they're not using all that money. They're living off about $300,000 of the income. So at the moment, they're paying tax on $150,000 each, $36,000 tax each, and they're distributing the rest to a company. So this is a lovely property development business. It's building all that new housing that everybody wants. And they're retaining money in this company at the company tax rate of 25% to fund more developments and build more housing. So when we change to 2029, the trust income would be $1 million, and the trust would pay 30% of that tax, so $300,000. Our distribution to Bob and Carol of $150,000, they don't have any further tax paid on that, but they have paid more than they would have now. If we distribute that $700,000 to the company, it gets no credit for the tax that's paid. It's assessed again on the full $700,000 with zero credit and pays $175,000. So totally we've paid $475,000. And it could, I mean, if we distributed the whole lot to the company, it could be $600,000, so 60% tax. And then we haven't got it out to the individual still, which we'd have to pay tax on again on the dividend. So this is a huge problem where people are trading through trusts. If you're making a small income, that you won't pay more, and if you're making a large income, well, you can't really stop it being taxed at a crazy high rate by distributing to a company. This situation happens very often, multiple business owners. So a company is trading, but the shares are owned by the multiple owners through their discretionary trusts. So here we have an engineering firm with a $3 million business income, paying tax at 25%, and then paying the dividends out to all of the shareholders. Now, that just makes sense because you don't want to keep millions of dollars in a trading entity. If something goes wrong, you could lose the lot. So normally you would pay it out. You know, Bob here, as one shareholder, he's spending all that money. So he's getting taxed on all of it, and nothing will change for him. He's just going to still keep getting taxed on all of it. But Courtney was spending some of it, so she was getting taxed on $200, her spouse $200, and then a company of $600. So this will be a massive problem because that company would not be able to receive this at a concessional rate. And John had been in this business for a long time. He didn't need to spend anything at all. He was just retaining this money in his own company of $1 million. That will not be possible in future. So this structure is a real problem as well and will need to be looked at. And I don't know whether any of this will be able to be eligible for any rollovers. I mean, this is not a business itself. So lots of discretionary trust issues. You know, if you're trading through that and you want to pay wages instead, you have to pay super. So you'll lose that from your cash flow. It also sort of relies on you estimating exactly what the profit of your business is going to be at the start of the year to pay that level of wages, which nobody ever knows. And then, you know, if you pay that at the level you expect and then there's a downturn towards the end of the year, you will have paid wages you didn't need to. And you will have paid a lot more tax than you needed to then as well. I think my question is, why are trusts being taxed more than wages to make the system fairer? I can't see an easy fix for businesses with multiple owners yet. It's only been 5 days, so we'll keep thinking. And we'll get more details. But you end up with a completely different outcome if you trade through a company or trust. And I mean, I think there's going to be a lot of unnecessary restructure costs.